What's up, guys? Humphrey here. So what's the best investing strategy for the majority of investors? Well, the answer usually includes something with index funds and staying lazy. Index funds are great for those that want to buy and hold, not have to pay massive fees for active management, and they want to grow their money passively. I would even argue that one of the best strategies for the average investor out there is to put most of their money into index funds and simply just check it once a year. So in today's video, I'm going to give you a brief overview of what an index fund is, and then we'll get straight into it and talk about the 5 best index funds to own for life. I think if that you're new to investing, having just one of these funds as one of your core holdings is going to be good for you for the rest of your investing career. And as always, I'll leave timestamps in the description below and as chapter markers so that you can skip around whenever you'd like. So what is an index fund? An index fund is basically a pooled type of investment that you can buy within your brokerage account. When it comes to index funds, the way that works is basically the fund itself diversifies and buys into many different types of sectors. So by buying that one fund, you own a small percentage of everything that it owns as well. Think of it like cows. Yes, cows. So a cow is like a stock. And if you invest all your money into one cow, but that cow all of a sudden falls over and dies one day, well, all your money is gone along with that cow. However, you could invest in what's called the herd, and by owning the entire herd, if one of the cows dies, well, you're gonna be just fine. In both cases, you only own a small percentage of the cow or the herd, but you'd much rather have the herd because it's more diversified and you have more of your money spread out across many different cows. Now, in this particular example, I wonder what the milk is because I actually have some milk right here, and I'm trying to think about what it would be, but maybe these are like the dividends of the index fund or the cow or the herd that you might actually own. So cheers. So if you'd much rather have a real world example, let's say you buy into the S&P 500 index fund. Well, by buying that one fund alone, because that S&P 500 index fund invests in all the companies in the S&P 500, by buying that one fund, you're buying a small percentage of every company in the S&P 500. If you wanted to invest individually in each of the companies in the S&P 500, that would be incredibly tough, but by having an index fund that tracks the S&P 500, you essentially can. There are other advantages to owning index funds as well, including Warren Buffett saying for everyday investors, it is one of the best ways to actually invest your money, as well as his regular recommendation is just a low-cost S&P 500 index fund. Okay, so then the question becomes, if I'm interested in investing in index funds, am I just going to buy one of the funds or am I going to buy multiple of them? That's a good question, and my answer is that a lot of the index funds will hold overlapping holdings, so you don't really want to be overlapping your holdings, but plenty of diversification is always good. So if you do have more time to research index funds, it is worth adding a few more to your portfolio. But if you only have time to buy one index fund, that's going to be just fine as well because they're already naturally diversified. As a reminder, guys, just investing anything at all is better than investing nothing. So with that being said, let's get into the list of 5 index funds, and we're going to start with number 5, VVIAX. So VVIAX is actually a Vanguard value index fund, which invests in the stocks of large US companies and market sectors that tend to grow at a slower pace than the broad market. It typically invests in larger, safer companies. In short, it's mostly about stability and less about growth. The return since it was created in 2000 has been roughly 6.84%, and in the last 10 years, it's returning about 11%. Now, if you don't know, Vanguard is the home of the index fund, so a lot of Vanguard index funds are the cheapest on the market in terms of expense ratios, which just means that they have very low fees. This particular index fund has 328 total stocks in its holdings, and its top 10 holdings are Johnson & Johnson, Berkshire Hathaway, JP Morgan, Procter & Gamble, etc. You can tell that these are large, stable companies. The only downside of this particular fund is that because it's holding so many large cap companies, it actually might underperform the broader stock market. The other downside of any Vanguard index fund, in my opinion, is that you need to buy it typically on the Vanguard.com platform, and they usually have a minimum of $3,000 to invest in any single index fund. But luckily, they do also have an ETF version of this, and it's actually ticker symbol VTV. So luckily, ETFs are able to be purchased from any type of brokerage. So you could buy into the Vanguard ETF VTV, which is actually trading at $127 per share right now, on other brokerages such as Robinhood, Webull, Public, Fidelity, etc. All right, so the next ETF I really want to talk about is VFIAX, or the ETF version is VOO, and this is one of the most popular index funds that Vanguard actually offers. It's an index fund that tracks the S&P 500, and it's well diversified in that manner in that it actually tracks all the companies in the S&P 500 plus a few more. This is one of the gold standards of index funds, and honestly, it tracks about 11 different types of industries and a bunch of different sectors with no sector more than 30% of the total weighting. In terms of VFIAX, it has an expense ratio of 0.04%, which again is very, very cheap. It's $4 per $10,000 that you have invested in it. The average expense ratio of a mutual fund or any other type of active fund is about 0.63 to 0.74%. So it's good to note that the expense ratio on VFIAX in particular is very, very reasonable. Now, in terms of the holdings, it is just tracking the S&P 500, which is weighted by market cap. So the top 10 holdings are something like this. It's Apple, Microsoft, Amazon, Google, Facebook, and Tesla. Those are the top 6 holdings, and it just kind of goes down the list from there. In terms of the fund returns, since it's been created, it actually has been averaging about 7.31%, and in the past 10 years, it's done pretty well at 13.39%. Now, again, because this is a Vanguard index fund, you're going to need at least $3,000 minimum to actually invest in VFIAX, and that's why I actually gave you the other option of the ETF, which is ticker symbol VOO. If there was only one index fund that I can put all of my money in and only ever check it once per year, I would probably choose VFIAX or the equivalent ETF VOO. So that fund is pretty awesome, and so far we've covered 2 Vanguard funds, but now I want to talk about number 3, which is a Fidelity index fund. This particular one is ticker symbol FNILX, and this is a Fidelity Zero Index Fund. What I mean by zero index fund is it has 0 fees, and that is one of the biggest draws of this fund. Now, this is one of the newer products that Fidelity offers, and my guess is that they're trying to compete with Vanguard and take market share over from Vanguard over to Fidelity by offering these proprietary Fidelity index funds. FNILX is actually Fidelity's version of Vanguard's S&P 500 index fund, which we just talked about, VFIAX. Now, it tracks the S&P 500, but they can't advertise it as such because putting S&P 500 into the Fidelity Index Fund's name actually requires paying a licensing fee, which they don't want to do. So for now, it just labels itself as a large cap index fund, but really it's tracking the S&P 500, and that's all you really have to know. It's only been around for 2 years, and one of the benefits is, as I mentioned earlier, the 0.00% expense ratio, but the other benefit is that it has a $0 minimum to invest in it. We can see that it actually has the exact same holdings as VFIAX, which are just the same holdings of the S&P 500 weighted by market cap. Now, the only downside I see with this fund is, if you can even call it a downside, is that you need to sign up for a Fidelity brokerage account. Now, if you already have brokerage accounts at, say, Vanguard, and it's already well established, you might not want to switch over all your assets to Fidelity because you might take a taxable event. So in that case, is it worth the switch over? Well, that's definitely up to you. I would actually argue if you're already invested in, say, VFIAX, where the expense ratio is 0.04%, or just basically a few dollars per $10,000 that you invest, I don't really know if it would be worth the switching over from Vanguard over to Fidelity just for this fund. If you are a new investor, however, and you're trying to decide between a brokerage, well, Fidelity definitely looks pretty lucrative at this point because of the zero fee index fund and all their other features. So that was number 3, and that was a great index fund, but let's actually talk about number 2, which might actually provide higher returns just with higher risk. It's one of the growth and income index funds that we're going to be talking about today, and that's ticker symbol VQNPX. Now, this is a Vanguard fund that focuses on growth companies as part of their core holdings for this type of fund. This fund's main purpose is to outperform the S&P 500. So if you don't want to track the S&P 500 and you want to take a little bit more risk and try to outperform it, then this is the index fund for you. It actually tracks over 1,788 different companies. Because it's tracking that many different companies, it's actually going to start to hold a lot more smaller type of companies that might be a little bit riskier, but have the potential for a lot of growth. So this is one of those funds that you can actually invest in when you're younger, and it's probably best to do so when you're younger because of its higher risk propensity. You want to be taking on more risk when you're younger so that you can take advantage of time in the market, and hopefully by getting higher returns with this index fund, you're going to be a little bit better off towards the end of your investing career. So in terms of returns, since it's actually been created in 1986, this is pretty interesting here. It's returned about 10.72%. and in the last 10 years, it's returned to 13.77% on average. It's definitely returned the most since it was created compared to all the other funds that we're talking about today, but please keep in mind that it does come with higher risk and a little bit higher reward for that risk. I would say there are some downsides to trying this fund out, and that is the expense ratio is a lot higher than the other Vanguard index funds that we're talking about. It comes in with an expense ratio of 0.23%. Not to mention, it is a Vanguard index fund, so you do need to invest at least $3,000 minimum to get in. So that fund came with a little bit more risk, but it did track 1,788 different companies. Now, what happens if we actually want to track the entire stock market? Is there an option for that? Well, indeed there is, and that's actually our number one pick for today. The number one pick for today is an index fund, which is a three-way tie, and all these ticker symbols basically do the same thing. They all invest in the total stock market. First, we have Fidelity's, which is a Fidelity Zero Index Total Market Fund, and that's actually ticker symbol FZROX. That's also tied with Vanguard's VTSAX, which is the total stock market. And if you want the ETF version of any of these, it's VTI. Now, the Fidelity version will obviously have no fees because it's one of their newer zero index fund products. It'll have no minimums and no fees, but the Vanguard one, VTSAX, will have an expense ratio of 0.04% and a minimum investment required of $3,000. Now, the beauty here of these index funds is that it buys into every single stock in the total market, and that's over 3,640 different companies. This gives you the ultimate exposure to everything and the ultimate diversification to everything. So as long as the stock market trends upwards, you're going to be making money. Since its creation in the year 2000, VTSAX for Vanguard specifically has returned about 7.82%, and in the last 10 years has returned over 13.78%. The ETF equivalent has done the same because it just mirrors what's in the index fund. And for the types of contenders to just buy one fund for the rest of your life, this is definitely at the top of my list. I do think that index fund investing is one of the most underrated types of investment strategies out there, especially as part of anyone's core portfolio. I do think that people do tend to get caught up in day trading, options trading, and swings trading. If you're looking for a set it and forget it type of investment strategy, then index fund investing is definitely for you, and it's one of the most easiest ways to grow your money and track the market over time. All right, guys, if you got any value out of this video, which I hope you did, please make sure to drop a like on the video, subscribe to my channel, and tick the notification bell so that you can get notified whenever I drop a new video. If you'd like some free stocks from any of these following brokerages, Webull, Public, or Robinhood, I have affiliate links in my description below, so if you'd like to get some free stocks, just check those out. If you got this far, I sincerely thank you for checking me out, and thank you to all my Patreon supporters. I appreciate you guys being here. I'm going to finish this glass of milk because it would be wasteful to not finish it, and enjoy. So cheers. I'll see you guys in the next video. Peace.